Most people watching the quantum computing industry are still arguing about whose chip has the most qubits, whose error rate is lowest, or whose roadmap sounds the most believable on a conference stage. While that debate keeps running in circles, one company has quietly stopped playing that particular game altogether and started doing something considerably rarer in this entire industry, actually making money and making it at a pace that doesn't look like anything else in the sector. That company is IonQ, and the numbers it just posted aren't speculative roadmap promises measured in years or decades. They're real, audited, quarter-over-quarter revenue figures, and they tell a story that's honestly been flying under the radar compared to all the noise around qubit counts and fault tolerance timelines. Let's walk through exactly what IonQ just reported, how it stacks up against its closest publicly traded competitors, and why this particular growth curve matters for the entire quantum industry's credibility going forward. This matters more right now than it might have a year or two ago because the entire quantum computing sector has spent most of the last decade existing almost entirely on promise rather than proof. Investors have poured enormous sums into companies pursuing wildly different hardware approaches, traptons, superconducting circuits, neutral atoms, photonics, all racing toward a commercially useful machine that, by most serious estimates, remains years away from broad practical deployment. In that kind of environment, the easiest story for any quantum company to tell is a forward-looking one: bigger chips coming next year, lower error rates coming the year after that, a fault-tolerant breakthrough, always sitting just on the horizon. Those stories are genuinely important for tracking technical progress, but they're notoriously difficult for outside observers to verify in real time, and they don't pay anyone's bills in the meantime. Revenue, by contrast, is the one number in this entire sector that can't be spun, delayed, or explained away with a roadmap slide. It either showed up in the bank this quarter or it didn't, and that's exactly why IonQ's recent results deserve a much closer look than they've generally received outside of dedicated financial circles. Start with the headline number because it's genuinely staggering once you sit with it for a second. In the first quarter of 2026, IonQ reported revenue of $64.7 million. That figure alone might not sound earth-shattering sitting in isolation, but compare it against the exact same quarter 1 year earlier, and the picture changes completely. That $64.7 million quarter represents 755% growth year over year, not 75%, 755. To put that in plain terms, IonQ's revenue this quarter was more than 8 times larger than it was during the same 3-month stretch just 12 months prior. Numbers like that essentially never show up in mature industries because mature industries don't grow that fast. They show up almost exclusively in genuinely early stage markets where a company is converting from pilot programs and government grants into real, repeatable commercial sales practically overnight. What makes this particular quarter even more impressive is that it wasn't an isolated, one-time fluke driven by some unusually large single contract landing at a convenient moment. This was IonQ's fourth consecutive quarter of record-breaking results, and according to the company's own description, the single biggest quarter in its entire corporate history up to that point. The reported revenue also beat the company's own previously issued guidance range by a meaningful margin, exceeding the midpoint of what IonQ itself had projected by a full 30%. Companies routinely sandbag their own guidance to ensure they clear the bar comfortably, but beating your own midpoint estimate by 30%, 4 quarters running, signals something considerably more substantial than lucky timing. It signals genuine, accelerating underlying demand that the company's own internal forecasting models are still struggling to fully anticipate. Riding that momentum, IonQ didn't just celebrate the quarter and move on. The company's leadership team used the results to immediately raise full-year revenue guidance for 2026, pushing the expected range up to somewhere between $260 million and $270 million, an increase from the previous guidance range of $225 million to $245 million issued only months earlier. Management is now explicitly projecting more than 100% organic revenue growth for the entire year, a figure that excludes any contribution from pending acquisitions and reflects purely the existing core business continuing to expand on its own momentum for a publicly traded company to raise full-year guidance this aggressively after just one quarter rather than cautiously waiting to see how subsequent quarters play out is itself a meaningful signal of internal confidence that doesn't show up often in young, still unprofitable technology companies navigating genuinely uncertain markets. Underneath that headline revenue number sits an even more revealing metric that tells you something important about where IonQ's future business is actually headed, not just where it currently stands, remaining performance. Obligations, often abbreviated simply as RPO inside earnings reports, represents contractually committed future revenue that hasn't yet been recognized on. The book's IonQ's RPO climbed to $470 million, representing growth of 554% year over year. Put that number in context against the quarter's actual revenue, and the relationship becomes genuinely striking. For every single dollar of revenue IonQ recognized during the quarter, the company added roughly $2.50 in backlog committed for future periods. That ratio matters enormously for any investor or analyst trying to judge whether a single blowout quarter represents a sustainable trend or simply a temporary spike that's about to level off. A rapidly growing backlog suggests the demand pipeline feeding future quarters is, if anything, accelerating rather than slowing down. The composition of where that revenue is actually coming from matters just as much as the raw growth percentage itself, because it reveals whether IonQ is building a genuinely diversified, durable business or simply riding a handful of lucky one-off government contracts. Roughly 60% of the quarter's revenue came specifically from commercial customers rather than government or research contracts, a meaningful shift for a company whose early years leaned heavily on exactly those kinds of public sector relationships. 35% of revenue came from international customers, and the company has now sold its solutions in more than 30 different countries, compared to just a small handful of countries only a single year earlier. That kind of rapid geographic expansion, going from a few countries to more than 30 in roughly 12 months, suggests IonQ's sales organization has found something that reliably converts into closed deals across wildly different markets and regulatory environments, rather than depending entirely on one or two anchor customers willing to take an early speculative bet. Perhaps the most strategically important detail buried inside these results is the rise of what the company calls multi-product revenue. Roughly one-third, specifically 35%, of IonQ's quarterly revenue came from customers purchasing more than just raw quantum computing access. These customers are buying combinations spanning computing, networking, sensing, and security products simultaneously, treating IonQ less like a single hardware vendor and more like a genuine platform company offering an entire connected suite of quantum-enabled tools. This distinction matters enormously for the company's long-term valuation case. A business selling one narrow product to customers is perpetually vulnerable to a single competitor undercutting it on that one specific offering. A business successfully cross-selling multiple distinct product categories to the same growing customer base is building the kind of durable, sticky commercial relationships that are considerably harder for competitors to dislodge later, even if a rival eventually builds a marginally faster chip or a marginally lower error rate on some narrow technical benchmark. None of this growth has come without real financial cost, and it would be dishonest to describe IonQ's situation as anything resembling comfortable profitability. The company reported an adjusted EBITDA loss of nearly $97 million for the quarter alone, with research and development spending climbing to roughly $126 million as the company continues pouring resources into scaling its next-generation hardware. Stock-based compensation alone added another roughly $129 million in expense for the quarter, a figure that's become a genuinely common point of criticism leveled against fast-growing technology Companies generally, since heavy reliance on stock compensation can dilute existing shareholders even as headline revenue figures climb impressively full year. Adjusted EBITDA loss guidance remains in a range between $310 million and $330 million, a genuinely enormous sum for a company whose full-year revenue guidance sits well under $300 million. IonQ is, in blunt terms, still losing considerably more money than it's currently bringing in, and anyone evaluating this story purely through a traditional profitability lens would reasonably flag that gap as a serious concern. What makes IonQ's specific situation somewhat more comfortable than it might otherwise look is the sheer size of its balance sheet cushion. The company held roughly $3.1 billion in cash, cash equivalents, and investments as of the end of the quarter, giving it an unusually long runway compared to nearly every other publicly traded company in this still nascent industry, smaller rivals included. To put that cash position in perspective, it's roughly 12 times larger than the company's entire annual revenue guidance for the full year, a cushion most early-stage technology companies in any sector would consider an extraordinary luxury. That kind of financial firepower matters enormously in a capital-intensive field like quantum hardware, where building, testing, and scaling next-generation chips requires sustained, expensive investment over multiple years before any individual product line becomes reliably profitable on its own. It's also part of why IonQ has been able to pursue an aggressive acquisition strategy at the same time it's scaling its core business organically, rather than being forced to choose one path or the other the way a more cash-constrained competitor typically would. Now here's where the fastest growing claim genuinely earns its place, because IonQ isn't simply growing in isolation. It's growing dramatically faster than its closest publicly traded peers in the exact same sector, measured using the exact same reporting. Rigetti Computing, a competitor pursuing a different superconducting chip-based architecture rather than IonQ's trapped I don't approach, reported first quarter 2026 revenue of $4.4 million, itself a genuinely strong result representing nearly triple the $1.5 million Rigetti generated during the same quarter 1 year earlier. That's a real, meaningful growth story in its own right, and Rigetti has its own genuine technical milestones 2.2 as well, including general availability of its 108-qubit CFuse-1 system, a modular design built from a dozen separate 9-qubit chiplets achieving a reported 2-qubit gate fidelity above 99%, a respectable benchmark by current industry standards. But compare Rigetti's nearly tripled revenue against IonQ's more than 8 times larger figure, and the gap in absolute scale becomes obvious immediately. IonQ's single quarter revenue of $64.7 million dwarfs Rigetti's entire quarterly result by roughly a factor of 15, even though both companies can legitimately claim real, double or triple-digit percentage growth over the same comparison period. D-Wave Quantum, the third major publicly traded pure play in this space, actually posted a year-over-year revenue decline for the same quarter, falling roughly 80% to $2.9 million, a drop the company has attributed largely to the simple fact that the prior year's comparison quarter had been unusually inflated by a single large, one-time system sale that didn't repeat. D-Wave has pointed instead to its growing recurring revenue from quantum computing as a service offerings as the more meaningful long-term signal investors should actually be watching, separate from the lumpy, unpredictable nature of occasional large hardware sales, and the company has also highlighted strong recent customer bookings as a sign that demand remains healthy even when quarterly revenue recognition looks volatile on paper. D-Wave's approach itself differs meaningfully from both IonQ and Rigetti, relying primarily on quantum annealing technology rather than the gate-based architectures the other two companies pursue, a distinction that matters for which categories of problems each company's hardware is realistically best suited to solve. Even granting D-Wave that more charitable framing, the side-by-side comparison across all three companies reporting within days of each other in May 2026 makes one thing fairly difficult to dispute. IonQ is currently operating at a meaningfully larger absolute revenue scale, growing at a dramatically faster year-over-year percentage and converting that growth into a far larger committed future backlog than either of its two closest direct, publicly traded competitors in the exact same quantum computing sector. There's also a broader policy tailwind worth understanding here, because IonQ's growth isn't happening in a vacuum separate from government industrial policy. The United States government has recently committed roughly $2 billion toward building out the domestic quantum computing sector, a move that sent shares of nearly every publicly traded quantum company higher on the announcement, IonQ, D-Wave, and Rigetti included. Interestingly, IonQ itself was not among the specific companies selected for direct funding under that particular government program, which makes its continued outsized growth relative to peers who did receive direct government backing even more notable, since it suggests the company's commercial momentum is being driven primarily by genuine customer demand rather than dependence on any single funding stream. Looking at the full year picture for context, IonQ generated roughly $130 million in total revenue across all of 2025, compared with approximately $25 million for D-Wave and just $7 million for Rigetti during that same full year, meaning IonQ already entered 2026 with a revenue base more than 5 times larger than its closest publicly traded rival before this latest quarter of accelerated growth was even reported. Visible alpha consensus forecasts gathered around that same government funding announcement reinforced the gap between IonQ and its rivals at the full year level as well, projecting IonQ would more than double its full year revenue to roughly $270 million, a 108% year-over-year increase, while D-Wave and Rigetti were projected to grow 79% and 241% respectively, reaching roughly $44 million and $24 million. Even granting Rigetti the single highest percentage growth rate among all three companies on that particular projection, IonQ's absolute dollar growth for the year still dwarfs every other publicly traded competitor in the sector by a wide margin, simply because it's compounding off a substantially larger existing revenue base to begin with, and percentage growth off a tiny base will always look more dramatic than percentage growth off a genuinely large one, even when the underlying dollar impact tells a very different story. IonQ has also been busy expanding well beyond pure computing hardware sales during this same stretch, and those moves help explain exactly where some of that diversified multi-product revenue is actually coming from. The company was selected by DARPA for a program supporting heterogeneous quantum computing architectures built around quantum interconnect technology, work specifically focused on linking multiple smaller quantum processors together into larger combined systems rather than trying to build one single enormous chip. That kind of modular, networked approach matters because it offers a potential path around one of the field's hardest unsolved engineering problems. Building a single monolithic chip large enough to handle truly useful workloads has proven extraordinarily difficult across every competing hardware architecture, and linking smaller, more manageable processors together through high-quality quantum interconnects could theoretically sidestep that bottleneck entirely. IonQ has also begun commercializing dedicated quantum sensing products as a standalone business line, alongside global deployments of post-quantum cybersecurity solutions designed to protect organizations against the eventual arrival of quantum computers powerful enough to break today's encryption standards, a market that's grown increasingly urgent as governments and financial institutions worldwide begin transitioning toward quantum-resistant encryption standards ahead of schedule. The company sold its first sixth-generation, chip-based 256-qubit system to the University of Cambridge during the quarter, a sale specifically anchored by a broader secure quantum network and intellectual property generation partnership spanning computing, networking, sensing, and security all at once, exactly the kind of bundled, multi-product deal that's been driving the cross-sell revenue figures described earlier alongside that sale. IonQ also received its first I don't trap chip samples back from the fabrication facility during the quarter, marking what the company describes as a pivotal shift from component-level development toward genuine integrated system-level scaling for its next-generation hardware platform. The company has also pursued a pending acquisition of chip manufacturer Skywater Technology, a deal management expects will help position IonQ as the largest dedicated quantum hardware merchant supplier in the industry once it officially closes, expected sometime in the second or third quarter of 2026. That acquisition would give IonQ direct in-house access to advanced semiconductor manufacturing capacity, reducing its dependence on third-party foundries for the increasingly complex chip-based architecture underpinning its newest generation of trapped I don't processors and giving the company considerably more control over its own production timelines going forward rather than waiting in line behind other customers at an external manufacturing partner. So what does all of this actually add up to beyond an impressively large percentage? Sitting at the top of a press release, it suggests IonQ has managed something genuinely rare for a company operating inside a technology sector still widely considered speculative and pre-commercial by most serious industry observers. It has started converting technical credibility into actual, measurable, recurring commercial revenue at meaningfully larger scale than any of its direct publicly traded competitors, while simultaneously expanding the sheer number of distinct product lines customers are willing to purchase from it. That doesn't mean IonQ has somehow solved quantum computing, made its technology commercially indispensable, or eliminated the very real financial risk that comes with running at hundreds of millions of dollars in annual losses, while competing in a field where the underlying core technology itself remains genuinely unproven at true commercial scale. But it does mean that, measured by the one metric that ultimately matters most for any company's long-term survival, actual revenue walking through the door and converting into committed future contracts, IonQ has quietly built a meaningfully larger and considerably faster growing business than virtually anyone else currently operating in the broader quantum computing sector, public or private. If this kind of breakdown of the real numbers behind the quantum computing hype is useful to you, hit that like button and subscribe, because there's plenty more digging into this sector still ahead. The gap between flashy roadmap announcements and genuine, auditable commercial traction is exactly where the real story in this entire industry is quietly being written right now, and it's happening faster than most casual observers following. Only the headline qubit counts currently realize. Subscribe and turn on notifications so you don't miss what happens when IonQ reports its next quarter and the rest of this fast-moving sector tries to keep pace.